It wasn't a flash crash. It wasn't a glitch in the trading algorithms. It wasn't even a sudden loss of consumer confidence. It was the structural breaking point of a symbiotic trade relationship. For $120 billion erased. Not over a decade. Not over a year. In the blink of an historical eye. The catalyst was specific. China's announcement of 70% retaliatory tariffs. A number designed to shock. A number designed to halt commerce. But the cause was much deeper. The market reaction was not fear. It was recognition. Recognition that the era of cheap goods is over. Recognition that the global supply chain is not a safety net. It is a noose. When the world's factory raises the price of admission by 70%, the math changes instantly. Margins evaporate. Inventory becomes a liability. Asset values, heavily leveraged on the assumption of frictionless trade, rate downward, violently. This is not a political dispute. This is an economic siege. The arithmetic is merciless. If you cannot import components, you cannot finish products. If you cannot finish products, you cannot book revenue. If you cannot book revenue, you cannot service debt. The pattern is unmistakable. We are watching the dissolution of a financial marriage. And historically, the divorce is always more expensive than the wedding. The incentives are clear. For decades, the rational move was to outsource, to strip mine domestic capacity for quarterly profits. Now, the bill has arrived. The risk is that the entire valuation model of the Western markets was built on a variable that is no longer constant. This sequence is not unique to the 21st century. It is the standard operating procedure for empires in decline. A dominant power overextends. It relies on foreign labor and foreign resources. It finances this consumption with debt. Then, the supplier demands real payment, or the supplier cuts the line. Proof of this dynamic is etched into the historical record. We see it in the Mediterranean. We see it in the Atlantic. We see it in Central Europe. Let's look at the Spanish Empire in the 16th and 17th centuries. Spain was the master of the world. Gold and silver flowed from the Americas into Seville. It seemed like infinite wealth, but Spain made a critical error. They used that wealth to buy foreign goods rather than building domestic industry. They outsourced their production to the rest of Europe. The peak dominance was undeniable. Philip II ruled an empire where the sun never set. But the costs of empire were unsustainable. Wars in the Netherlands, the Armada, the bureaucracy. To pay for it all, they relied on the treasure fleets. But when the silver flowed in, it triggered the price revolution. Inflation soared. A shoemaker in Castile could no longer afford the leather to make shoes because foreign demand drove prices up. The chosen monetary shortcut was debasement. The copper vellon currency replaced silver. The result was instability. The middle class was priced out of their own country. Wealth fled into land and titles, leaving the economy hollow. By the mid-17th century, the Spanish economy was broken, not by a lack of money, but by a lack of productive capacity, just like the Spanish Empire. The British Empire followed the same trajectory between 1914 and the 1970s. Just like the Spanish Empire, the British Empire followed the same trajectory between 1914 and the 1970s. Britain was the workshop of the world. The pound sterling was the global reserve currency, as good as gold. But to world wars shattered the balance sheet. The imperial costs were astronomical. To maintain the illusion of dominance, Britain relied on credit from its allies and extracted resources from its colonies. But the industrial base began to rot. They had failed to modernize, relying on the inertia of past glory. The monetary shortcut was devaluation. In 1931, Britain broke the link with gold. In 1949, and again in 1967, the pound was devalued to try and boost competitiveness. But you cannot devalue your way to prosperity. The resulting inflation ate away at the savings of the British public. A dock worker in Liverpool saw his wages rise in nominal terms, but his purchasing power collapsed as the cost of imported food skyrocketed. The flight into hard assets accelerated. Those who owned property survived. Those who relied on a weekly wage fell behind. By the 1970s, the once mighty empire was the sick man of Europe, forced to go to the IMF for a bailout. Just like the British Empire, The Weimar Republic in Germany demonstrates the extreme end of this cycle. In 1914, Germany was an industrial titan. By 1919, it was crushed by war debts and reparations external obligations it could not meet. The French occupation of the Ruhr in 1923 was the equivalent of a total trade blockade. The industrial heartland was seized. The German government's response was the ultimate monetary shortcut. They ordered workers to strike and printed money to pay them. The result was the most famous hyperinflation in history. It wasn't just about printing paper, it was about the collapse of production. With the supply chain broken by the French occupation, goods vanished, money became worthless. A clerk in Berlin might order a coffee for 5,000 marks and find it cost 8,000. By the time he finished drinking it, the flight into assets was absolute. A piano, a sack of potatoes, or a plot of land became the only real wealth. The middle class was vaporized, setting the stage for total social fracture. The pattern repeats in 7 distinct stages. Stage 1 is the era of peak dominance and financialization, where the power believes it can consume more than it produces. Stage 2 is the emergence of unsustainable costs, usually driven by military expansion or social entitlements. Stage 3 is the turning point, where the power faces a choice between austerity or a monetary shortcut. They always choose the shortcut. Stage 4 is the onset of inflation and supply shocks, dismissed at first as transitory. Stage 5 is the flight to hard assets, where real estate and commodities decouple from wages. Stage 6 is social fracture, as the population realizes the social contract has been broken. Stage 7 is the new equilibrium, usually established after a massive transfer of wealth. Just like Stage 1 through Stage 7 describes the past, it maps perfectly onto the current crisis triggered by the 70% tariff shock. The loss of $420 billion in U.S. wealth is not a fluctuation, it is the realization of Stage 4. The supply chains that allowed for cheap consumption have snapped. Current data suggests that for every percentage point increase in tariffs on critical components, domestic production costs rise disproportionately due to the lack of immediate alternatives. The incentive for China is clear. They are leveraging their dominance in manufacturing to inflict economic pain, signaling that the era of the subsidized American consumer is over. The risk is not just higher prices at the shelf, it is the inability to produce essential goods. Some economic historians note that tariffs can stimulate domestic industry. One interpretation is that this pain is the necessary cost of reindustrialization. However, this view ignores the time lag. Building a factory takes years. A tariff shock destroys margins in days. The arithmetic is merciless. If you cut off the supply of intermediate goods before you have built the capacity to replace them, you do not get a boom, you get stagflation. The incentive for capital during this lag is not to build factories, which is risky and slow, but to flee into existing hard assets, further driving up the cost of living for the average citizen. The endgame always arrives in one of 3 ways. First is controlled decline. This is the British path. The currency slowly loses its status. Living standards stagnate, and the nation accepts a reduced role on the world stage. We saw this solidify in the 1970s when the pound ceased to be a primary reserve asset. Second is chaotic collapse. This is the Roman or Weimar model. The system creates so much phantom wealth that when the correction comes, it destroys the currency entirely. The 3rd century crisis in Rome saw the silver economy of the denarius drop to near zero, wiping out the commerce of the empire. Third is reset and restructure. This happened at Bretton Woods in 1944. After the chaos of depression and war, the global powers gathered to rewrite the rules of money and trade. This usually involves pegging currencies to a new anchor or revaluing gold to clear the debt. The only variable is timing and pain. Subscribe to the channel to track these signals as they emerge. Preparation is not about predicting the exact day of the crash, but building resilience against the inevitable volatility. Focus on acquiring skills that are independent of complex supply chains, and understand the data that drives these cycles.